Thanks for joining us today on Market Call. I'm Orrell Fernandez. Richard Orrell is with us on the show, portfolio manager at RN Croft Financial Group. He'll take your questions today on exchange-traded funds, and here's how to reach us. 1-855-326-6266. You can email your questions as well, marketcall@bnnbloomberg.ca. Good to have you in. Thanks for coming in.
Thank you, Marilla. Thank you for having me.
What kind of year do you think 2026 is shaping up to be for the markets?
Oh, boy. I mean, that's a really loaded question, right? Everyone wants to know your outlook. We're almost 1 month into the new year already. But here's what I'm looking at, okay? So we've started off 2025 or 2026 with a fairly, I would say, Goldilocks approach. As we heard both central bank presidents yesterday, okay, where they're at as far as fiscal monetary policy. Okay, so very happy with where they're at. Not looking to change rates in the short term. I think that's good. I think the trend is lower. That would be supportive of markets. And so I think we're in a bit of a wait and see. And in my portfolios, I've kind of been on a sit on my hands approach. So kind of wait and see as the market, S&P 500 touched all-time highs yesterday. So more wait and see. Volatility is still low, although today is giving us a little bit of a spike in volatility. So I'm keeping my portfolios in line, and I'm maybe looking to add some tactical items here and there, which we'll get into later in the show.
Okay. What do you see as driving the wider economy first in Canada?
So for the Canadian economy, I've been actually very surprised how resilient it's been. Okay, so the consumer is still the number one piece. And as we see these earnings, we're kind of in the middle of earnings season here, as you know, and I'm seeing a lot of announcements come coupled with layoffs. And so as we look into the risks and what could sidetrack some positive momentum, I definitely see layoffs and how that moves through the economy as one of the risks out there. But it's still consumption for the most part in Canada and the U.S. that drives the overall economy. Okay,
we know sentiment has been low, especially in the U.S. for consumers. What do you see driving growth ahead for Canada? You mentioned unemployment could be a drag because consumers won't spend money, but what are the possibilities for growth?
Well, we've seen a bit of stuff out of Ottawa. Okay, so I'll describe it that way.
Fiscal policy, yes.
Yeah, some positive momentum. I think it'll be up for the leadership to continue on that path. They promised some good things. They've had some good words, but will they follow through with action? And that could be really positive for Canada. We have a lot of untapped potential here. We've been looking for that to be untapped for a long time. And so that would be a key driver in the resources sector, materials sector, those type, even energy as well. If those can, start to move to other trade relationships, that would be very, very positive for Canada.
Are you hopeful that some of that will get out the door this year?
Of course, hopeful, but these projects take a long time. And so I think, you want to see some ground being broken.
Shovels in the ground, yes.
Shovels in the ground, exactly. Can't right now, obviously it's pretty cold out.
Sure.
But yeah, we want to see that in the longer term. And again, that's that connection between, okay, this sounds really great, sounds very good. The Davos speech last week was fantastic, but can we actually get that momentum and get some physical action?
Okay. Let's take a quick break then. We'll line up the first phone calls for Richard Orrell, RN Croft Financial Group. Again, he's taking your questions today on exchange-traded funds. Here's the number to reach us and the email address as well. We're back in just a moment. Welcome back to Market Call. We have Richard Orrell here, and we have an email here from Richard as well. He says, hello. I'm interested in the guest opinion on TD's TPU.T ETF, tracks the S&P 500, and how it compares to VFV ETF. So the broader S&P on the TPU, what is the VFV one?
Is also the S&P 500.
Got it.
Yep.
How do they compare?
Quite closely, actually, Marilla. So they just, for all intents and purposes, have different index providers. So we'll get into the nuances of ETFs a little bit, but usually there's a tracking index that they have, and the VFV is the S&P 500 by S&P Global, and the TPU is by an index provider called Solactive. But if you go through their documents and look at the holdings, they're very similar. And so depending on the time frame, and if you can put up a comparison chart, whether it's 3 or 5, they often just oscillate within a few percentage points. Okay, so I actually use TPU as a core holding in my client portfolios. The MER is slightly lower, I believe, than the VFV, but really they're both good choices.
Okay.
Now,
so you could go either way.
You could go either way. And where I would use something like the VFV if I have TPU is, let's say I have a tactical sleeve and I want to move off that tactical sleeve, but I don't want to combine cost base in a non-registered account. I could use the VFV just to sit and get market performance.
Okay. I hope that works for Richard as we move to our first phone call today from Sam. He's in Brampton, Ontario. Hi, Sam.
Hi, Morella. Hi, Richard.
Hi.
Thanks for taking my call. Richard, my question's on XDIV from iShares. How big a position? I've been building a position in that particular ETF. So my question to you is, what percentage of position I should hold in this particular ETF? I really like it because it's so concentrated with about 22 stocks that are all quality stocks, good paying dividend. And yeah, go ahead.
Okay, thank you for that question. So this is a dividend stock. Do you know the kind of companies that are tracked in this ETF?
Yeah, so this is the XDiv by iShares. As the caller mentioned, it holds a fairly concentrated portfolio. That can be okay. I prefer a bit more broad approach. In Canada, when you get to the XDIV, you're looking at about 50% financials, which is fine, but you're really concentrated. So I tend to lean more towards wider diversification as far as sectors, and unfortunately in Canada, you often just don't get that. You've got high-weighted financials, energy, and materials. And so I look at, there's another one by iShares called the XDG that I look to diversify out, and you get less Canadian exposure, more US. There are some tax considerations here because Canadian dividends are favorable, but just I'd like to broaden out the exposure and make sure you're hitting more sectors to get a bit of a smoother ride.
And what percentage would you put in? Because that was his other question, right? If you're going into an ETF like this, is there a sort of a roundabout number you would give to him?
Well, that's so specific to
what
each
he already
client
has,
situation.
yes.
It really depends on where, like, age and stage and where they're at in their journey. Could XDIV be a core? For me, it's too narrow to be a core position. I would have it as a strategic. So for me, it'd be a 10% sleeve.
Okay.
That's where I would put that ETF.
Okay. Let's go on to Rob then. Rob's on the line in Calgary with a question. Hi, Rob.
Hi. Thanks for taking my call. I don't know if I'm too late to the party, but I'd like to hear Richard's opinion if he thinks precious metal, the precious metal run will continue. And if so, could he recommend a precious metal ETF? Maybe it holds, gold, silver, platinum producers, and perhaps one that employs a covered call strategy for a bit of income. Thanks for your advice, and have a good afternoon.
Okay, thank you for the question. So let's talk about whether you think he's too late to the party to jump on.
That's a really tough question, Morella. So I think if you have a position in gold, you're in good shape. I would be looking to kind of sprinkle some into the market. So otherwise, lower your weight in that. I would not want to be taking a brand new position in gold here. It's just gone, silver as well, in particular, has gone parabolic. And so I've been speaking about clients with taking some off the table. There will be a pullback. I imagine it'll be quite violent. And so if I was going to do and look at something, I would probably go with the XGD. Okay, so just, I mentioned XDG, which is the dividend paying stock. So you got to be very careful if you're punching these on the screen.
Okay.
They're very close. But the XGD, I believe it's the global gold. That would be the one that I would look at.
And is that just gold, or is there sort of a wider precious metals ETF that you could look at as well?
Well, that one, a lot of those miners aren't just exclusively gold. They have other byproducts when they're drilling. So they'll have silver exposure. Companies like Wheaton Precious Metals will be in there. So they'll have exposure to both gold and silver. Off the top of my head, you can also go into some of the bullion. There are some ETFs that have mixed bullion, but I can't recall which of those ones off the top of my head.
Okay. Rob, I hope we've given you some options there. Let's go to our next caller. Gordon is on the line. He's in Victoria, BC. Hi, Gordon.
Good morning. I'm looking for an alternative to my money market fund where I'm getting a hair under over 2%. And I'm thinking safety of capital is important, short duration blue chip corporate bonds. What do you think?
Okay. What would you toss out there as a possibility?
Right. So we've been holding a lot of C-bill, which is exactly as the caller described. It's very safe, short-term government. Anytime you want to take on more risk, you got to go up the curve. So corporates would be kind of the next spot where you would go for a bit more return. And we've recently added into one of the pools I co-manage the FHIS. It's short-term corporates. It's by Franklin Templeton. The NAV has stayed fairly stable, and it does give you a little bit more return. So you're getting into that 3.2, 3.3 range. And as long as you have a fairly positive outlook on Canada, and despite all the noise and trade relationships and all that that's going on, I think it's a fairly safe step up if you're going to get off the beach, where the beach is where where you'd be with your government bonds. You want to wade into the ocean, you can take on some corporate debt.
Okay, that's FHIS, and that's the Templeton one you said, right?
Yeah.
Okay, is there another comparable that you can give them just for choice?
Just for choice? Well, you could also look at iShares. So the XXSH is also on the short end. So that would be another one you could look at. I don't know, well, there's 1,800 different ETFs out there, right? And so I just saw a report from TD saying 346 last year came out, 1,800 total in Canada. So I'd have to do a bit more due diligence just to see how they compare.
Has it slowed down at all at the start of this year? I know last year was a big year for ETFs.
Mm-hmm. No, I don't think it's slowing down. I mean, it's good for investors. There's more choice, but we're also seeing further risks, in my opinion, being developed in the ETF market. So innovation is nice and great, but we're starting to see individual stocks with covered calls and things like that. These are instruments that are fairly sophisticated, can lure investors with yield, but may not be the best for the portfolio. If you look at the history of ETFs, they started out in Canada. XIU, I believe, is one of the first original ones, and it was a passive approach, and it gave you a wide basket. So we've gone from that approach, and we still have those approaches today, to very specific, unique, and niche products. There's obviously some demand out there, but as an investor, you need to make sure you know what you own, and it's becoming more and more complicated to do that.
Okay. Let's take a quick break then. We'll line up some more phone calls and some emails for Richard for when we come back. Stay tuned. Welcome back, and thanks for joining us. We will do an email from Betty right now. She says, what does your guest think about blockchain ETFs like a BLOK and BKCH? Do you invest at all in blockchain?
We don't invest directly in blockchain, but these ETFs are both fairly broad-based. So you can pick out a few companies that we may have some holdings in. These two ETFs, I do like the idea of targeting a relatively nascent, like a new sector, like blockchain. I mean, it's been around for a few years, but it's still kind of finding its way, finding its path. I like using an ETF because you're not going to set yourself up as much for failure. You can still see a big drawdown, but if you pick 2 or 3 companies, we could pick the wrong ones. But if you have a broad basket, that protects you to some extent. Of these two, I have a bit of I prefer Block. Okay, it's an active ETF. It has really fairly good risk-adjusted returns, but I would still caution that this is for a speculative part of your portfolio. This is not, it does move up and down, but even in that, you do have some companies that you would recognize. Robinhood, IBM is in there, the CME Group. So some other companies that have businesses that aren't just fully focused on blockchain.
Okay. Interesting mix of businesses there. Let's go to Trevor. He's on the line today with his question. Hi, Trevor.
Oh, hello. My question is on ZEB, the Equal Weight Canadian Bank ETF by BMO. Now, here's something. NAFTA is going to be renegotiated, and the old NAFTA, American banks could not buy into Canada, even though Canadian banks were allowed to buy into American banks. If that changes, what happens to this ETF? Thank you.
Okay, thank you for the question. This is the BMO Equal Weight Banks Index. Would there be a change if that reverses?
I would find that hard to believe. I would think there'd be more threat of potentially the U.S. participants entering the market as opposed to the end up probably built from the ground up, as opposed to taking over some of our largest banks. Canada has a reputation we've earned through the financial crisis many years ago to be among the most stable and well-capitalized banks in the world. Our chief investment officer, Richard Croft, just wrote a nice big piece about the Canadian banks. And I don't think that they're not going to be acquired, in my opinion. I could be absolutely
And
wrong.
that would be the only way you would see the ETF being affected.
Well, I mean, new entrants would also potentially impact them, right? If there's more competition,
Sure.
could be good for consumers. But I don't see, especially given the geopolitics and where we're at as Canadians right now, us flocking to a U.S. option in the banking sector. So the move in the banks has been strong. They pay great dividends. I would stay. I don't know if I'd be adding necessarily, but I would stay and keep the ETF in the portfolio.
Okay. Let's go to Ghulam in Toronto with a question. Hi, Ghulam.
Hi there, good afternoon. My question is on ZWE. I was looking at ZWE and ZWK because I already own two ZWB and ZWU. So ZWE is the one I'm looking at. Do you think it's a good time to buy at this time? I'd appreciate your opinion. Thank you.
Thank you for the question. ZWE is?
European, broad-based high
dividend. Okay.
European dividend. So I actually like what's going on a little bit in the rest of the world. We're seeing a rewiring of some of these trade relationships. India and the EU just announced what they called the mother of all trade deals. I think that was a direct jab at who we know.
Yes.
At someone else.
His name will not be mentioned here.
Yeah,
yes.
It wasn't huge, but it was the mother of all trade deals. And I think there's more fiscal spending going on in Europe. So Europe's always been kind of a slower growth. When you look at PE multiples, it's the growth that has really charged up the American market, and Europe has always been kind of less growth. But I think that might be part of this change, is that these companies might have to start to look to expand and move other places and maybe protect themselves and spend a bit more money. So I don't mind Europe in here. As for the caller's question as to whether it's now, I don't know, right? My crystal ball is no better than anyone else's, but I do like the opportunity in the international markets.
Okay, so that was the BMO's high dividend. Let's go to the next caller, William in London, with a question. Hi, William.
Good afternoon. My daughter owns the stock SPY, which she's had for many years. Should she keep adding to it or just hold?
Okay, thank you for the question. We will see if we can pull up the chart for SPY. Do you know it?
Yep. So SPY is the main S&P 500, not by market cap, like not by assets anymore. I don't think. I think the Vanguard one moved past it, but as a trading vehicle, it's been very, very popular. It's SPY market performance, right? So it's S&P 500 fully, and I really like these ETFs that are, they're low cost, they track the market, and so they're very much a hold, right? So if you have one in your portfolio, just keep it and enjoy the ride. The caller mentioned it's his daughter, so I'm assuming it might be a bit younger. So 5-10 years out, it's going to be in good shape.
Okay, let's go to another caller then. Anita's on the line. She's in Markham, Ontario, with a question. Hi, Anita.
Hi, good afternoon. Thank you so much for taking my call. My question is on VEU, Vanguard FTSE All World Except US Index Fund. I don't have much exposure to global stocks except through VEE, so I was wondering what your thoughts are on this if I buy it at this price. Thank you as well.
Okay, thank you for the question. Pulling up VEU right now. Tell us about it.
So Vanguard does a great job of naming some of these ETFs, so it's very easy to understand. So it's an all-world, but no U.S. Companies. So anything that's domiciled in the U.S. would be excluded. Now, that being said, some of these companies probably have revenues back in the U.S. So you're not getting rid of all U.S. exposure, but you are getting rid of those companies. I can't speak to the specific Vanguard one. Obviously, Vanguard is known for their low cost, but I do like, kind of building on the previous Europe call, I do like some of the international markets. They performed very well last year. So if you look at, I saw one chart in one of our investment meetings last year. I think the S&P did only 18%. Korea, Spain, some of these markets had very high numbers, 50, 60% returns. So I think there is opportunity still there. They've been depressed markets for a long time. And I think, as the caller mentioned, it's a good diversifier. And when you're building portfolios, I do appreciate trying to move around and make sure you're diversified.
Okay, I guess part of the question for her was, do you jump in at this point? It's at 78, 51 roughly. Mm-hmm. A lot of these have run up, right? As you mentioned, the markets have done well. They've run up. Should they wait for a little bit of a pullback, or should they just invest where it is today?
You really have to make that call yourself. I often kind of talk about anyone can buy a stock when you sell it. That's kind of more of the, but you want to pick your price point. I'm still fairly positive on the outlook. You get a day like today, maybe it's not enough of a pullback, but I would add if you're got a longer term time horizon, yes, and some of these ETFs are very broad based, yeah, you add.
Okay. Let's take a quick break, then we'll go through past picks. When we come back, stay tuned. Time now to go through past picks from Richard. These are from July 22nd of last year. At the time, he chose Invesco on the Nasdaq 100 Index ETF, QQC .F at 180.64 last July, now to 267. So a 11% upside and total return 11% as well. Is this one you still like, remain invested in at all?
Yes. Yeah.
Tell me why.
So at the time, I was looking at this pick or the next pick to client portfolios, and I chose this one basically on the AI theme. I still like it. I still think it's good. And what I wanted to emphasize, though, is I picked the hedge version. And so at the time, it looked like the US dollar might come down. It didn't work out that way, but now we're seeing the support from before broken with the US dollar, and there's obviously things going on with gold as well in that space. But so I like that hedge. I really like that hedge component, because if you're following the Nasdaq but you're not hedged, then you can lose on the currency. So I still have this in portfolios. I'm still keeping it. I have no plans to change it.
Okay, let's get to your next past pick. Global X Artificial Intelligence Semiconductor Index ETF, a CHPS on the TSX. It was 44.57 at the time. It's 61.51 today, so 38% upside. Total return is the same. Can you give me an idea of the stocks under this banner?
Yeah, so it's a fairly concentrated portfolio. Taiwan Semi is in there. I believe NVIDIA, ASML, I believe, as well as I think even there's some Micron in there, which has done really, really well recently. I'm sure you've had guests talking about. So this one, unfortunately I chickened out. I went for the QQC.F. I should have gone for this one across the board. But anyway, hindsight's always 2020. I did add it for some clients in corporate accounts that have a longer term time frame. Because in corporate accounts, I often don't want to have too many dividends and things like that. So if you have a long time frame, you want capital gains. And so I did put it in there for a few clients. I still see a long runway. You're going to get some volatility, even between July and now. We've seen a 20% drawdown in semis, but we recovered. So from what I'm hearing and what I'm reading on the reports, capacity is often booked out all the way through 2026 for these companies. And so I still like that ETF.
Oh, okay. I just want to ask you more generally in the tech sector, because we've seen it come off late last year, and we haven't seen a lot of them come back. How do you feel about some of these big tech companies moving forward for the rest of the year?
Well, it's interesting. So I agree. The Mag 7, which had all the headlines early in the year, have come up. Well, Microsoft today is really getting hit, but that's okay. In my opinion, that's okay. You need in the market to be to keep going. You need rotation, and you need to move from sector to sector. So even today, as I left, you got maybe a tech wreck today, but of the 11 sectors in the S&P 500, 7 were still positive. So it's red on the screen because those companies have earned in the indices that right, but there's still some strength underneath in different in other sectors. So. That's going to give and take depending on the day. But I still like the outlook for technology because it's paused, and that might be what it needs to kind of shake out some people, and then it can accelerate again.
Okay, let's get to your last past pick. iShares Core S&P 500 Index ETF, which is hedged. XSP on the TSX, 64.87 last July to 70.59 now, so 9% upside, 10% for total return. Have you remained invested in this one?
Yes, this is an absolute core holding. I work with a fellow named John Hood. He has his clients invested in this for years. So we occasionally trim, but we often just keep this one as a very core holding in portfolios, anywhere between 20 to 40% potentially.
Okay, so pretty high.
Yeah, pretty high.
and you're happy holding it for the longer term.
Yes.
Okay. All right, let's take a quick break then. We'll get back to your phone calls and your emails with Richard Orrell of RN Croft Financial Group. Again, he's taking your questions on ETFs. We're back in a moment. Welcome back, and thanks for joining us. Let's get back to the phone lines. Paul is on the line. He's in Edmonton. Hi, Paul.
Hello.
Go ahead.
My question is about Royal Canadian Mint Canadian Silver Reserve, ticker symbol MNS on the TSE. What could happen if 50% of the owners of these shares all tried to sell their shares roughly all at once, say during the same week? Could MNS become insolvent? Could the MNS investors lose all their money invested in MNS?
Okay.
That's my question.
Thank you for the question. Very specific question. Has something like that ever happened with an ETF?
Not to my knowledge. They can close ETFs for sure, but usually there's some amount of assets that are still remaining in ETF.
And you would hope that the mint, if they have an ETF, would have assets left at the end of the day.
Right. So what I think the caller is getting to is there's a lot of stories in the silver world about, how much physical and how much paper is out there and chasing this story. And as prices go up, when it's the rate of change that is really troubling, right? Prices can go up, but when they go up fast, that's when things in the market can potentially break. And so maybe I'm summarizing what the caller might be suggesting, but he's wondering about reserves versus what's actually in there. So as more certificates get issued or ETFs get issued, they've got to keep putting silver in the vault,
sure.
Right? Again, if it's the Royal Canadian Mint, I would think that they'd be doing their job. But again, these are speculative areas of the market where I would not recommend much higher, definitely not higher than 10, probably not higher than 5% weight in this. But really, the price can come down. They'll get rid of silver. I don't see investors losing all of their money because of a structural problem in the ETF.
But you also did suggest that precious metals could correct, or at least gold and silver, and it could be violent.
Of course, right. I think I saw today. I was watching gold as it was coming down, yes. And it was down 5, then it was down 3. These are substantial moves. And when you look at futures markets and how much money is out there and what the margin they have to put up, it's substantial. And so anytime you get into these markets, you've got to make sure that you're being very cautious and taking profits along the way, because something could happen. And again, I don't think it will happen in this. I think that the structure of the ETFs are very strong, but protect yourself.
Okay. Let's get to our next caller then. Carthy on the line today in Toronto with a question. Hi, Carthy.
Hi, Marla. Hi, Richard. So I was looking into diversifying into either BMO China or BMO India ETF, particularly ZID. So, and I see that the price, even from last year to now, it's much lower. So do you think it's at an attractive price to buy right now, or should I invest in ZCH?
Okay, thank you for that question. It has fallen off quite a bit. This is BMO India Equity Index ETF. How do you feel about the forecast for India, I guess, and would you pick it up at this level where it is today?
So, as a portfolio manager, we don't always know what's going to happen. We don't know what's going to happen for sure, but we do have tools at our disposal. One is a plan, and the other one is risk management. Okay, so we can manage risk. So if I'm looking at that chart there, and I look at different lenses, I don't mind that. It's a bit of a pullback. It's been on sideways, a bit of a pullback, but you can see it's pulled back to its previous low point there, and also you can see it's kind of a breakout from further back as well. So if I'm taking and I'm trying to measure potential downside versus upside on this one, I would take a stab here, but I would keep a tight stop on it, not to let it get carried away. Okay,
I was going to ask, would you wait for the bit of the bump up to make sure that that's the support level before you dip in?
You could. I mean, that's a personal preference. without kind of some of my charting software and things like that in front of me, I can't make that call. There's certain technical indicators I look at. But I think there's an opportunity to manage risk there. And that is prevalent through a lot of what I do, is can you see an opportunity and can you get maybe a 2-for-1 kind of risk versus upside potential?
Got it. Okay, let's go to an email then from Roger, who says, I'd like to know if your guest would add to ZLB today. Let's see if we have the chart for ZLB, and tell me a little bit about this. So it's low volatility by BMO.
Low volatility. Is it Canada?
It's low volatility Canadian equity ETF.
Yeah.
Yes.
So it's Canadian low vol. From our research, low volatility is a fairly good factor in Canada. So ETFs often, they build on different factors. So, and we'll get into it. I have a couple of picks that have some factors. Low vol is one of them. Dividend screens is another. There's many different factors you can put into that screen through the stocks. So you look at a big universe of stocks and then use that to kind of bring it down to a much more narrow focus. In Canada, low volatility seems to work. It doesn't actually work as well in the U.S., but in Canada it does work, maybe by the nature of the companies we have. So if the investor is trying to look to take a fairly conservative stance, but still wants to participate in the equity markets, I believe that ZLB would be appropriate.
Okay. Let's go to another caller. Mary is on the line in Nanaimo, BC. She's got a question. Hi, Mary. How are you?
Good morning. I'd like to know how you would structure a portfolio of ETFs for a first-time investor in their registered accounts. They're young, they have lots of time, but they're nervous because this is their first time.
Okay, so something that's not going to be volatile and something that's going to grow their money so they can sort of appreciate making money that way for the first time.
Yeah, this is always a concern of mine with a young investor. You want to make sure they get off to a good start and don't get scared on their first endeavor. So as part of that growth in the ETF world, we've had a lot of asset allocation ETFs pop up. So Mary, instead of building a 5 or 6 different ETF portfolio, I would start off with something like a VBAL. Okay, so VBAL is a balanced portfolio by Vanguard asset allocation. They basically allow that portfolio would have 60% equity, 40% fixed income. And again, it's probably too high income traditionally for a new investor, but because it's their first endeavor, that side of fixed income can help buffet some of the volatility and give them potentially a positive experience. Now, if markets get, if they tank, you're still going to lose money, but it's not going to be as aggressive as, say, if you're 80-20 or 100% equity and really scare them as much.
Okay, the Vanguard Balanced ETF might be a good place to start. Okay, let's go to a quick break. Back with your phone calls in just a moment. Stay tuned. Welcome back, and thanks for joining us. Let's go to Edwin on the line. He's in Enderby, BC today. Hi, Edwin.
Yes, good afternoon. Thank you for taking my call. Yeah, I was wondering if UMAX is fairly safe to be invested in. And another question is, can you tell us if all ETFs listed on the Toronto Exchange, do they qualify for a tax-free trading account? Thank you.
Okay, thank you for the question. So this is the Hamilton Utilities ETF UMAX is what he's looking at first. Can you speak to it?
Yeah, so Hamilton has this suite of Yield Max ETFs. I'd have to double check and see if it has any leverage. So I don't usually use any leverage in the ETFs that I like to do. And I spoke about earlier how you have these different factors or different strategies. So you can have a covered call strategy. Then some of them have an enhanced covered call strategy where they use a little bit of leverage to kind of bump up that return a little bit. This is in the utility space. I haven't been super positive on this space in Canada, but I'm looking potentially at a bottom. If, as we mentioned at the top of the show, if we can start to see some infrastructure build out and things like that, that could be positive, and we get some momentum. So I'm looking at it, but I haven't. It's definitely down the list of things to add.
Okay, and he also wanted to know about whether or not it's fine in a registered account.
Yeah. So I'm not
a tax-free account.
Yeah, I'm not a tax expert. Usually, if you go and check the ETF on the fact sheet or online, you'll see if it's eligible. And so I can't make a blanket statement like all ETFs are eligible.
Okay. Let's go to another email then from Joan. She says, could you please ask your guests' thoughts on VRIF.to, Vanguard Retirement Income Portfolio as a holding for a retiree? What would be in this kind of ETF retirement income? Is that banks?
It's a very broad ETF, actually. So I just mentioned VBAL, V Balanced. So Vanguard's done a bit of marketing here and says, oh, hey,
this is for a retiree
right here, right?
Yeah.
So what it is for asset allocation, it's about 33% equity and 67% fixed income.
Okay.
And you get a very broad portfolio by owning one ETF. I actually have held it for clients in the past. I moved out and kind of started to build the blocks a little bit more myself, mostly because there is, in my opinion, too much home bias. You get too much exposure to Canada, and I'd rather have a bit more. I historically always had a bit more US. So, but it's a good product. Depending on your level of income that you need, it might kick out, or you have to sell some units periodically. So it can definitely work for a retiree.
Okay. Let's get to another email from Carrie then. Carrie says, could I please get your thoughts on the ETF ENCC? I was wondering if the yield is sustainable. Let's pull up ENCC if we have that chart and take a look at what that dividend is. As we talk about it, it's one you're familiar with. I guess it's a global ex-Canadian oil and gas covered call ETF.
Right. So there's a couple things to unpack in that statement. And the main question is the yield sustainable? So the ENCC, we do have clients on the Croft platform that have the ENCC. The yield, I believe, right now is about 14%.
So it's a high yield.
It's a high yield. Anytime I see a double-digit yield, I always want to do some extra due diligence just to make sure what's going on. So the underlying companies pay about a 4% to 4.5% dividend. And then the other portion is coming from the covered call strategy.
Okay.
All right. But you're also looking at capital appreciation or depreciation in the sector of the companies. So ideally, if the ETF just moves sideways and volatility, everything would be good because Globex is saying at that level, we can create 10% of income annually from the covered call strategy. I think it's a bit high. If your outlook for oil is not as positive, I know it's having a nice pop today on some of the tensions.
But generally has been in a downward spiral?
Yeah. So I would prefer to see the yield more around 9 or 10. And I think that would be sustainable. Interestingly enough, if you look at this ETF and you bought it when it first came out, you'd still not be at break even. It's gone all the way down. And
How long ago did it come out?
I believe it came out in 2011.
Wow, okay.
Yeah. But the unit price, I think, went down to about $3 at one point. So it's really battled back. So the companies usually manage that distribution. And they try to fix it. But the caller's question is really important because what's the sustainability of that level? If I'm saying, hey, I always need this income to live or buy groceries or whatever, is it possible? And in some cases, it might be a bit high.
Okay. Let's get to another email before we have to take a break. Shiraz says ZWK, which is BMO's U.S. Banks ETF, is it a buy at the current price for exposure to American banks? Any upside? What is your overall outlook for American banks? Are they going to do well this year? And is this something you would look into, the ZWK?
Right. So the ZWK, it has a component to it. So the caller or the question came in. It actually has a covered call component.
Okay.
So what a covered call does is it dampens volatility, but it gives up upside. So if I was going to be looking strictly for upside in the U.S. banking sector, which is a sector I'm watching very closely right now, I believe there should be some positive momentum from deregulation.
The regulatory, yes.
Yes, exactly. We haven't seen it. I have a few positions I'm watching. That risk management piece is very important right here. So for this caller, the ZWK is going to give you a bit more of benign ride, and you're not having that upside. So I'd rather use either the the ZBK, which is equal weight U.S. banks.
ZBK. Yep.
From BMO, same thing, equal weight U.S. banks. And then BMO has also recently brought up the U.S. sector spiders. Okay, so the XLF, which is pretty common in the U.S. financials, you can buy the XLF.
Okay.
And then even further
to that,
you can buy a hedge version.
Okay.
Okay, so you got to watch your spreads here when you're trading it, but you could buy a hedged U.S. financial sector ETF at a reasonable cost.
Okay. Let's take a quick break. We have new top picks from Richard when we come back. Join us tomorrow for Market Call. Brianne Gardner will join us on the show. She is Senior Wealth Manager at Velocity Investment Partners, Raymond James, and she will take your questions on Canadian and U.S. large caps. That's tomorrow. Let's get to new top picks from Richard. We're going to start with this one, BMO's MSCI USA High Quality Index ETF, so ZUQ on the TSX. What do you like about this one?
Well, we talked about the factors that some of these companies use to screen the stocks. And so this one screens for a few things. So high return on equity, a stable year-over-year earnings growth, and as well as low financial leverage. So I like those screens. You do still end up with some of the top, NVIDIA, Broadcom, Google.
Some of the ones that are still volatile.
Some of the ones that are volatile. But it also moves it down into some of the mid-cap companies in the U.S. as well. If I can make one correction, I will be recommending the hedge version of this. So the ZUQ.F, BMO does have a hedge version of this. And so I use it in my portfolios. It's a core holding, and I don't have any intention of moving off it.
Okay. Your core holding would be how much weighted?
Somewhere between 10 to 20%.
Okay.
Yeah.
All right. Good to know. Let's get to your next pick, which is Franklin International Low Volatility High Dividend Index, ETF. So FLVI. And tell me about this one and how much do you own of it? What do you like about it?
So I'm looking at adding the international side. A couple of the models I follow look really favorable on that. So I went out and looked at different products in this area. And this one kind of layers two themes. So for Europe, it layers the low volatility and the high dividend piece, with potentially more spending over there and trade relationships changing and countries modifying. I'm looking to add the international. And this one, its benchmark is the MSCI EFI index, which is a fairly well-tracked index. And last year, it exceeded that index by about 8.5%. And has historically, if you look at the back test, done very well. So I like that type of idea, being in that area, Japan exposure, other markets. And so I'm looking at adding this as a tactical to complement my other sleeves in the portfolio.
And to be clear, you haven't stepped into it yet.
No.
Why not?
Why not? I'm not waiting for necessarily a price point. I'm just verifying and wanting.
You're still doing your homework.
I'm still doing my homework, sharpening my pencil, and making sure that it's the right one. I don't like to trade too much for a lot of my client portfolios. It's kind of boring, actually. It's more like watching paint dry. So I want to make sure that I make the right choice and then just manage the risk.
Okay. Let's get to your next pick then, which is Global X S&P on the TSX. So 60 covered call ETF. Tell me about this one.
So this is just the TSX Top 60 with a covered call. So we had a few calls about people wondering about if they'd missed the metals and things
the
like
run-up, sure.
The run-up. So I spoke with my colleagues, and we kind of came up with this as an idea that this way, the covered call, you dampen some of that volatility. You give up upside in case as the market's already run quite a bit, but you get a nice yield. So I think it's about a 7.5% yield. So this one would be more for your income-focused investors. It could be kind of that gateway between fixed income and a full equity exposure. And so I settled on the CNCC.
So this is a lot of miners, energy.
Top 60 in Canada. So it's back to the financials. It is a little bit concentrated. It does have Agnico, I believe, and a couple of the other miners. So it's a kind of a gateway into that and not taking on that full risk of that sector.
Okay, so because you mentioned it's kind of fixed income and kind of equities, who would be best to sort of take this one on?
Well, if you're seeking that income, but you have to realize that there is equity-like exposure to it. So, you look at your very safe fixed income, then your corporate bonds, and preferreds are in there somewhere, although they're fairly long term. I put the covered call ETFs just above those. So there's a bit of risk there, but you can manage it. And if you explain to your client, the other thing about covered call is most investors can't do it themselves.
Yeah.
To hold a portfolio of 60 stocks and write calls options on each one, it's nearly impossible. You have to have a few $1 million. So this way, you get all of that opportunity in one nice package.
Interesting. Okay, Richard, thank you very much for coming in. Good to see you.
Good to see you as well. Thank you.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.